Well, welcome everybody to the December 5th, 2017 edition of Turnout Tuesday. This is our mailbag edition where we're going to tackle some questions and suggestions made by audience members, either through email or posting on our forum or what have you. I'm joined here tonight by Ken Kavula. Say hello, Ken.
Hi, how is everybody tonight? Mid-Michigan chapter is really happy to have you all with us, and let's get this thing underway. We have some pretty good questions tonight, don't we, Mark?
I think so. I'm really hopeful that this type of thing can really dig a little bit deeper into some topics, some of them somewhat challenging from time to time and confusing, and just a real opportunity for all of us to learn from each other by openly asking and seeking answers to some questions. Our email addresses are there on the cover screen. Kavula1 at Comcast.net and Mark R at ManifestInvesting.com. And I do have to brag about something, Ken. I actually, for the first time in a very, very long time, am down to where my inbox fits on one computer screen. And it's just a joy. I mean, you don't know how challenging that can be over the years.
Yes, I do, Mark.
Well,
yes, I do.
I'm kind of excited. So, okay, let's get the legal paperwork out of the way here. Again, this is no investment recommendation is intended from anything that we do. It really is about demonstration of a multiple decade philosophy and investment method and technique as promulgated by the Modern Investment Club movement, also known as Better Investing or the National Association of Investors. It's certainly the inspiration for Manifest Investing. And again, we just want you to know that everything we do, we're very big on demonstration. We'll talk about that a little bit tonight, but big on demonstration of something that has worked very well. Many of you in the audience are smiling and take an extra sip of eggnog and raise your glass to an internet toast. You know that this stuff can be most helpful to an investor in a long-term investing experience. So we just welcome everybody that's here, and if you would like to be added, or if you have a friend that you would like to suggest to for either the roundtable sessions, which again we're going to continue, they are completely separate from the turnout sessions. You can send a note to nkavula1 at comcast.net down at the bottom of the screen there. That stands for Natalie Kavula, Ken's better half, and she takes care of the reminders and stuff. So let's go ahead and get underway. Now, I don't know about you, Ken, but I do get a little bit nostalgic. I can see you out there shopping and buying all those little gifts and just having a right jolly old time out there. It is the season, and again, this being the mailbag edition, I grabbed a few shots from Miracle on 34th Street, you know, the scene in the courtroom where the post office delivers the mailbags and the judge and Santa and all that kind of stuff. So again, thank you to all of you out there who submitted suggestions. If we don't get to them tonight, we will continue to build this type of program periodically. But tonight I thought we'd talk about four things and then open the floor up. The first being just a quick reminder about our work on the best small companies that's come to a kind of a conclusion here in the fourth quarter of the year. We'll take a quick look at that. Larry Reno asked a question about high PE ratios and what we should think about them and current PE ratios and relative value. We'll talk about that subject. This notion of capital gains and paying taxes, and it's certainly all over the news as they continue on Capitol Hill to mess with our tax structure, hopefully doing some stuff in a good way, but the jury's still out on that one. But this notion of just figuring that whole situation out. We'll spend a moment with a question related to that. And then we have this investment club from the Rocky Mountains investigators that basically asked a series of questions, and actually there's some even that we won't be able to cover here tonight that will probably continue the discussion. And then, of course, if there's any time left, we'll do Q&A.
Mark, I don't often get a hand raised this early in the session, and since I do have a hand up in the air this early, I'm going to unmute William Bennett. And Bill, if you'd like to say something, you're unmuted. Go ahead. And it appears we have an inadvertent hand. Bill Bennett, William Bennett, are you there? Okay, you're unmuted. Okay, I'm going to take your hand down, and I'm going to put you back on mute then.
So
And go on, Mark,
that's
continue, okay?
probably a good way to make a
I'm
point.
sorry. Was we moving around?
You might have to mute
Okay,
one
go
of the
on.
people there, Ken.
I've muted everybody. We're all set, Mark.
Okay, so again, Ken does monitor the questions tab. It's question or is it comments? Questions tab, right?
Questions tab, right, uh-huh.
So you can actually text in a question there or raise your hand, and we will attempt to unmute. We are very familiar with people just tinkering and maybe doing an inadvertent raising of the hand. So that sort of thing. Why don't you go ahead and talk a little bit about our quest for good small companies, Ken? And I thought you would really enjoy that cartoon because I remember you talking about weed a few years ago. I didn't even know what in the world you were talking about. I must not have had young people in my house.
You didn't have grandkids at that point. Yeah, nobody in the Cavuto family uses the Wii anymore except for Natalie and myself, and we use it as a portal to get on our Amazon account. But other than that, the gaming system is not being used. Folks, Mark and I have been looking at small companies now for maybe 10 or 12 years, and we used to look at the small companies that were provided to us by Forbes magazine. They used to put out a list sometimes of the best 100 small companies, sometimes even 200 small companies. It was a great list for us to mine for ideas. But they stopped doing that 2 years ago, and Mark and I have kind of stepped into the void, along with help from folks on the Manifest Forum and from folks that are just eager to help us out with some ideas. And we've distilled that list down to 40, sometimes 50 of what we consider to be the best small companies. And we're kind of looking for small companies that have some decent potential going forward, as long as having some decent growth that we've already seen happening. We're looking at small companies. We know that we'd like to see them grow at least at 10%. To my mind, I'd like to see them grow at 12% or better. And those lists are published at Manifest Investing. But I'd like to kind of show you, if you'll go one more slide, Mark, I'd like to show you the top of that list right now. And just since November 1st now is when this list started, since Halloween, this list of our best small companies has gone up 3.42% versus the Vanguard Total Stock Market Index. That's what the VTSMX stands for, Vanguard Total Stock Market Index, and it's gained a little bit less than 2.6%. So we're coming up on almost a 1% advantage after just about a month of returns right now. You can see that there's some pretty unknown companies near the top of that list. I'm not familiar with Kingstone Companies, but I will tell you that it's a stock that I'm going to take a look at least. BJ's Restaurant, I do follow that small company, and here it is, 17% since Halloween. I also follow Mercado Libre, and I follow Cambridge. So there's a couple ones that I know about at the top of the list right now, but there's also a fair number of ones that I think might be some very interesting stock studies. You put these onto an SSG like any other stock, and like any other large or medium-sized stock, I would urge you to ask for the same kinds of things to be happening on your SSG. Look for some history. Look for some straight lines in sales and earnings. Look for margins that meet or exceed the industry numbers. Look for return on equity at 15 or 16 or above. Look for those kind of things, and I think that if you'll not settle for lower quality just because it's a small company, I think in the long run you'll be extremely happy. Here's this Kingstone's companies that is at the top of the list right now, and that's a pretty great sales line, and it's not a bad earnings per share line. Green is sales, blue is earnings per share. and both of them together are interesting enough for me to want to study. I do notice that the net margins, depending on how I draw the trend line, some of you might say that the last 5 years are more indicative of what the margins are. So you might pick a margin, at 10 or 11% going forward. Others might say, well, there's an upward bias to these bars right here, and you might pick margins at 13 or 14 or 15%. That's what makes good SSGs, is differences of opinions. I also am looking at the PEs, and we're going to talk about Nosebleed PEs later on this evening, but this company certainly doesn't appear to have average PEs in the nosebleed territory. And this shifting around, this up and down of PEs with very small companies is fairly typical, especially as the company gets underway. I think we're going to appeal to our graph that we've used the last couple of sessions and talk about the fact that PE doesn't start to get consistent until we get to a place where the explosive growth kind of takes off, and then the PE stays fairly consistent or might even be moving on an upward trajectory. So I'm not worried about anything that I see on the screen right now, and I'm looking at a par value. That's a pretty decent par value for any company, but especially in today's market, when I see a par value of about 15% plus, I'm getting extremely excited. So here's a company I really do want to study, Kingstone Companies. I can't even give you a thumbnail of what it does.
I can just give a.
If you look at the bottom,
Yeah,
if you look at the bottom of the screen, Mark has pulled out a thumbnail, and if you can read that 1 or 2 sentence blurb right there, you get a real rough idea of what it's doing. And I'm getting a feeling that they're brokers as much as they are actual writers of insurance, but I'm not certain of that. So.
Yeah, when we first started looking at it, they struck me as kind of a Brown and Brown potential. They're actually classified under industry services by one of the agencies. So, I mean, it'll be interesting to see if they do kind of fit the same mold as a Brown and Brown and that sort of thing. So, yeah, nothing that I see there really bothers me either. Here's the list sorted from highest return forecast on the right. So again, I think I would go shopping over here and insist on the type of quality that Ken has been talking about. Some pretty decent names up at the top of that list. I do expect prestige brands to kind of correct back a little bit as we take a closer look at the Spick and Span company, and maybe that growth rate's a little bit ambitious for the type of company that it is. Anything else grab you from this list, Ken?
Well, and I've gotten some emails from various people that have said, well, why would you put high PE companies on a list like this? Well, sometimes small companies carry very high PEs, especially when they're companies that have been discovered by the general market and people get really excited about them. But if high PE companies are not your bag, there's a pretty long list of companies, and this is just the top of the sort, the first 10 or 12 companies, and if those two that Mark has circles around, Mercado Libre and Viva Systems, if they're too rich for your blood as far as the PE is concerned, then leave them off your study list. These are your studies. You don't have to look at all of them, and nothing is going to compel you to buy companies with PEs of 50 if in fact that makes you extremely uncomfortable. We are going to look at a capture from an actual SSG that George Nicholson did way back in the day, probably in the 50s, and we're going to see that high PEs didn't especially scare off Mr. Nicholson.
Mm-hmm. The other thing we should probably mention is those return forecasts on the far right, ranging from 24% for stamps, which, by the way, is down 25% in the last month, down to Kingstone at that 17% level. Those really are in that kind of, frothy, could be too good to be true type zone. So all the more important to demand high quality from those type of companies, in my opinion.
Yeah, and the higher that quality gets, the more that I would move into that amber zone that we're looking at right there. Remember that in the manifest system, that amber zone indicates that we're better than 10 points above where the market says is average. And I haven't looked in the last day or two, Mark. Where is my par right now? Is it around 6 something yet?
Running right around 6.2. So yeah, so we'll
6.2.
talk about that in a little more detail.
Yeah, so 16.2 would be the top of the plus 10. Nicholson always said, don't be greedy. It's very difficult to achieve returns more than 10% better than the market. And so that's why the amber background is there. Those returns are more than 10% above what we gauge the average to be right now. So I would have a little bit more faith in the higher quality companies than I would in the lower quality companies.
All right, so let's move on to one of those emails Ken just mentioned. This is from our friend in Atlanta, Larry Reno. Many of you know Larry. And after the October roundtable, he sent us all a note. Very cordial, very, very, very diplomatic. And he basically said, I'm having trouble with some of those companies that have relatively high PE ratios. I'm not real comfortable with companies like OLED. Mesa Labs has actually run up a bit. We've actually used the example of Neogen being discovered. I'm not sure what he was seeing with Alliance Data because that does have a lower PE. But again, I understand where he's coming from. He's talking about these companies that are kind of off the charts when it comes to PEs. And he goes on to say, you look at a current PE for Amazon, which I say is really not a valid number. And I have a hard time talking with my partners about investing in Amazon at a PE of 135. We certainly have felt this up close and personal when Hugh brought it a couple years ago at the Chicago convention, the national convention for the association. Nobody in the audience wanted any part of Amazon. And it's a tough one. It's a real tough one to chew on. And Ken's right. You can actually decide to walk away from it. But every once in a while, there is a place. I think this is where Larry is right. There's a place for a high flyer and for educated speculation about companies like this. So again, any of us that have been around long enough to remember 1999, yeah, you can get stung pretty hard on one of these high PE companies, particularly if it's a low quality company in combination. Ken and I were talking about this just a few minutes ago. So let's take a little bit deeper dive into these Nosebleed PEs and see if we can't demystify some of this stuff.
Well, Mark, before we leave that slide 7 with Larry's picture on it, I want to make a point about Mesa Labs and Universal Display. That's OLED. We spoke about those at the roundtable as being stocks that have done amazingly well since they were placed in the roundtable portfolio. I want to make the point that they were not hugely high PEs when they were placed in that portfolio. I've owned Mesa Labs for 7 or 8 years. I owned OLED for the last 3 or 4 years. And when I purchased these stocks, along with a stock called Neogen, which I've owned for maybe as much as 20 years now, maybe 17 is closer, I want to make the point that when they were purchased, they were lower PEs. And I think that when you have a stock that you've ridden for a while that was a great small stock and it's made you a lot of money, the mistake that I think people make is that as that PE moves up, they choose to get greedy about it. I think you have to take some money off the table, because if you don't, then that stock begins to take up a larger and larger piece of your portfolio, and that destroys some of your diversity. I think one of the biggest mistakes that was made during the tech boom was that people wrote a stock all the way up to levels of PEs that were in the 140s, 150s, 160s, and then they wrote that stock all the way back down again, all the time hoping for there to be a reversal and for them to make back the paper profits that they had made during the time the stock was rocketing upwards. There is a time in better investing philosophy when you take some profits off the table, when the potential for the stock you're looking at, especially as a non-core stock, when the potential moves below average, and that money can be better spent looking at stocks with more potential attached to them. We're not managing the round table tracking portfolio at the same way that you would manage a portfolio for a club. The tracking portfolio is just to keep track of the ideas that we've suggested, and then to keep track of how well we're doing with those ideas versus the market. So again, the point is that when they were really eminently purchasable, none of these stocks, especially the two that Mark has circled there, they didn't have nosebleed PEs. They're sitting with high PEs today, and I think that a great club, if they've spent some of their money in slightly speculative, non-traditional investments, as Mr. Nicholson suggested that you could do with 15-20% of your sophisticated portfolio with a mature portfolio, some of the money has to come off the table when those potential numbers begin to move down into the 1% less than the market, 3% less than the market, 4% less than the market. And the market number, if you're using manifest investing, or if you're using value line, you can come up with a reasonable average on what the average stock is predicted to do in the next 3 to 5 years. Right now, I think that all the numbers are kind of aligning somewhere between 6 and 7%, and that's a good number for us to use at the moment.
Mm-hmm. Well, one thing that I will point out, Mesa Labs, love the company. It's been part of the 10 Cup portfolio for a number of years, and that one is managed like a conventional portfolio. We actually decided to sell it on the recent run-up. And the second case in point is, unless there's a change, we have a roundtable coming up 2 weeks from tonight, and OLED is on the hot seat. And we're going to have to really rake that over the coals and talk about what we believe. And again, we keep coming back. We'll probably present this at the December roundtable. Remembering back to the days of paychecks when it had a PE of 50 or 60, and we knew that couldn't last forever. And we want to find a definition of, well, what is a reasonable amount of time for a PE to mature for a company like that? And I think it has bearing in how we look at a company like OLED over the longer term. So all valid points. Now, this is one of Ken's favorite slides. We used to use this in our, well, we probably still do in our commandments crashing or crushing presentation. Why don't you go ahead and describe this one for him, Ken?
Well, this is an actual photo taken of an SSG that was done by George Nicholson. And check out the high PE that he used to estimate going forward. For all you folks in the audience that thought that Better Investing had a rule that said thou shalt not use a PE over 30, Mr. Nicholson evidently did not abide by that rule. He noticed that the average for the high PE values was around 40, and he chose to use that average as he was calculating a potential high price for this particular stock. To be honest, I'm not even aware of what the stock is, and that gives the slide even more power that it's not that important, and you should let the numbers do the talking. Now, if the PE of 40 makes you uncomfortable, if you think that there's going to be PE contraction, then that gives you permission to lower that high estimate. But keep in mind, if you lower it unreasonably, if you cap it at an unreasonable level, then that takes away a lot of opportunity from really quickly growing companies. I'm not sure that there's much difference between a company that grows at 5% and you choose to give it a PE of 20, and a company that's growing at 20% and you choose to give it a PE of 40 or 50. I really do think there's a relationship that exists between the PE a company should carry and the growth rate that we're assigning to it.
Yeah, and it's not a simple relationship. The PEG is not a simple relationship. And I think just to amplify on your point, Ken, we actually did a study for Better Investing a few years ago where we went back and looked at what if you placed the limit of an upper PE of 30 on Microsoft, and basically came to the conclusion that you could never have owned Microsoft from 1975 up through the year 2000, because you had to be willing to go to a slightly higher PE during that time frame, fully aware that at some point it was going to come down to a normal PE for a technology company. But we actually showed that if you placed that limit on Microsoft for that entire time frame, it never would have reached your buy zone during that time frame. So again, I think that's the type of thing you want to be careful with companies like this. And that leads us into this next slide. We've used it a few times. I think it's a very valid thing. You talk about PEs over the life cycle of a company, from the birth of the company to the point where they begin making profits and everything is sloping up in the right trajectory. The area that we love to invest in is, again, as we pointed out a number of times, this is the up, straight, and parallel zone. As a company becomes a promising, exciting company that's maturing along the way, and sales and earnings are doing exactly what are shown there on the chart. Some of the companies that Hugh brings, including Amazon, is one case. A company that's back in that, somewhere in this time frame of before they're making consistent year in and year out earnings all the time. And the earlier you can find a promising, good long-term company on this picture, the better off you are. And the point that we want to make here tonight is you can actually use some slightly different ways of looking at investment analysis to do that sort of thing, to find companies a little bit earlier, which is exactly the type of thing that Hugh is doing. Let's try this one on for size. Left the name of the company off intentionally. What are your thoughts out there as far as this company? Would you be interested? Top line's pretty impressive. The prices are pretty consistent along with the bottom line there. And if that were an SSG, I think we would hear some chance of up, straight, and parallel. And of course, the trick question, or the answer to the trick question, is that is Amazon. That is Amazon.com. The top line is the sales line. The blue line is actually the cash flow, not the free cash flow, but the cash flow using the flavor used by Value Line. So again, this is what Hugh McManus is looking at when he makes that completely outlandish nomination at the Chicago convention. Here's what he's basically done. Taking a look at Amazon, and by the way, you got to love the Christmas tree there in the middle of the page. I watch Amazon delivering boxes all over the area every day. Somebody estimated that the average person spends 2 years unpacking Amazon boxes of their lifetime now. No, the problem with Amazon is they've got these periods of negative earnings. That the blue area that you can see running down the middle of the Value Line data array, there are actually negative earnings or very low earnings. And again, we know that anytime a company's earnings go negative, it actually explodes, kind of like the Silverdome we were just talking about in Detroit. Anytime that the earnings go negative, it wrecks the stock selection guide. And in the case of Amazon, they've gone negative as recently as 2014. The antidote for this, in dealing with a company, a very early stage company that seems to be fairly promising, is to substitute the green box, the cash flow, for earnings. Just forget, you can actually enter the cash flow numbers into your stock selection guides, and you'll be dealing with a price to cash flow instead of a price to earnings ratio. And that's how you end up with that slide that we just had up there. Now, the problem is, again, you can say that the PE for Amazon is 200. You pick whatever number you want. It doesn't have a PE right now. They're managing the company to basically not have a PE right now. So you can't talk about earnings and PE ratios for Amazon, not yet, because again, they're somewhere back in this range, somewhere where the earnings are just breaking through and not necessarily staying positive on a consistent basis. So here's what it looks like down to the numbers. Again, where we are substituting cash flow for earnings. So everything you see where you would typically see an E or a PE, you're going to see CF for cash flow, or a P/CF for price to cash flow. It takes a little getting used to. But again, this is a situation where you can take a look at either a early stage company, or in some cases Nicholson would use these for cyclical companies where the cash flow would stay positive, where the earnings didn't. That was true for many of the automotive companies for many years. But again, here we're looking at a stock selection guide done a slightly different way that has a lot of validity to it. And again, if we're right about this, I mean, just look out to the right-hand side. We're talking about a company earning a huge amount of money with a PE that most of us would not be terribly uncomfortable with out in that 3 to 5 year time frame. But that's a monstrous pile of earnings out 3 to 5 years from now, and it is feasible. It is feasible.
And I think it bears saying also, Mark, for those folks out in our audience that think that we're being cute by using price to cash flow rather than price to earnings, and that they think that that's something new. Value Line's been using price to cash flow in its graphs ever since Value Line's been in existence, and we certainly have decided that Value Line's a pretty trustworthy document to make reference to. In fact, if I'm not mistaken, isn't the price to cash flow graph the Value Line?
It is. They still use cash flow for every single company, and in fact, it probably it's a subject for another day. But with what's going on in the tax code, that's going to get very disruptive to the bottom line after taxes in some of our charting and analysis. So it's something to think about. It's not going to mess with Value Line at all because they use price to cash flow. So again, in this example, I mean, something that we talk about a lot of the time about companies like Value Line, in some cases Morningstar, certainly the NEIC community at large. A lot of times we'll look at a company, we'll end up with numbers like this, fairly conservative, when in reality this is not science fiction. In the case of an Amazon, it's not completely science fiction. It's speculation because it's a little different. But at the same token, if this profitability trend continues, again, it's cash flow margin, same type of margin or profitability concept that we use for the net margin in section 2. If that happens, I can make a heck of a case for that price to cash flow ratio coming in somewhere around 30, not necessarily around 20. That difference alone accounts for much of the difference between these two forecasts. So again, if this comes true, if the cash flow margin continues to improve and gives Amazon operating leverage and the opportunity to do things, this could certainly come true too. And it's not impossible to believe. So we'll have some fun with that. Again, I think that companies like Amazon can be wonderful investing opportunities, again, for that non-traditional, non-core, whatever you want to call it, component of your portfolios. It's the type of thing that has really generated a real boost to the returns achieved by people like you, McManus, over the years. All right, so let's go ahead and talk. We've been talking a lot about PEs. This one kind of dovetails with Larry Reno's question. That's not Larry Reno, and it's not the person who submitted the question. That's George Nicholson with the Santa hat. George is regarded as the grandfather of our modern investment club movement, the originator of the stock selection guide. I just wanted to throw a couple darts at this whole notion of relative value. Relative value on the stock selection guide is something that actually kind of grew in the last 20 to 25 years. I sometimes blame it on programmers with too much time on their hands, but it really is this notion of, I guess my biggest problem with it is everybody out there is always looking for this simple thing like the PEG ratio, or I can look at a PE and tell you whether a company is overvalued or not. Well, you can't. You can't look at just the PE because it's just one piece of the puzzle. You have to really take into account, as it says here, when you do your calculation in section 4 of a stock selection guide, you have to combine, what your growth expectations are along with the profitability and what type of trajectories those are on in combination with a projected PE ratio. And the current PE ratio is not even part of that discussion. So again, I think many aspects of the National Association were tugged in a direction towards these PEs, when Nicholson used to really have a hard time with it. And you can see, I'll let you read that last paragraph down there. He really did push back on some of these notions that the PEs were the one piece of the puzzle that could be used to manage portfolios. And I would say it's actually done considerable damage to many. I don't think that's too strong. I think when you start over relying on PE ratios to tell you things as one single piece of information, you really are making yourself vulnerable to errors, the same type of errors we see Wall Street make every day. And that's kind of this whole message of, why would we ever settle for that? Why would we ever settle for something less when we've been given a recipe which is not that much more complicated, but it really does effectively address the multiple pieces of a jigsaw puzzle known as a completed return forecast. So some good clean fun there. And then I'll just conclude with, I think one of the best dissertations I've ever sat through was with Tom O'Hara, the guy in the hat on this slide. And he talked about this whole notion of reading too much into the current PE. And this whole notion of, hey, the PE on this company is 60, that means it's overvalued. It doesn't necessarily mean that. You have to look at, again, where's the company in its life cycle? Is it a company like Amazon? Is it a cyclical company? And again, Tom takes us through this whole notion of, be careful, because a PE all by itself can be misleading and uninformative. I would say even dangerous. And you really want to take some of this, scratch your head over this, because he spells it right out here. This is an interview from 1998. He's talking about Amazon here with an emerging company. You need to spend more time figuring out what's really involved here. Where are they in the growth cycle? What's the economic cycle? All this stuff all ties together. And again, his suggestion is you can't just look at the PE. You have to look at how this stuff all comes into play. He used to be very critical of this notion of a signature PE as something which doesn't exist. And that's all part of the relative value calculation. So again, just be careful with using that. It is one piece of information. As he says, he did use it for certain companies. I can tell you which companies he used it for, mature companies which actually had something approaching a signature PE. So it's all something to think about, and just kind of scratch your heads over when somebody tries to oversimplify, how to look at a company like this.
I'm enough of a teacher, Mark, to know that when you put a paragraph onto a blackboard or onto a slide or something, or even onto a piece of paper, that a lot of folks don't read very much of it. So I'm going to direct people's attention to the number 2 in the last paragraph, in the last window down there. And I'm even going to read it out loud, where it says that you should be looking at the business cycle when you're looking at PEs. Average PE ratios are highly correlated with inflation rates. And I think that's another really important thing that we've lost sight of in this period of extended, extremely low inflation. And the correlation, in my mind at least, is inverse, that PE ratios tend to get smaller as inflation tends to get larger, and they tend to inflate when inflation itself gets very tame, or moves as it has for us in the last 6, 7, 8 years down to levels under 2%. I mean, that's a really, really low number for those of us in the audience that can remember buying homes with interest rates of 12, 13, 14% on the first or even the second home that we bought, or paying 10, 12, 14, 16, 18% on a car loan. So that today, when we're looking at interest rates, we need to keep in mind that PE ratios are correlated to that rate of inflation, and that's so often ignored or just kind of blown off.
Yeah, and one of the things that Tom used to like to say about relative value is it doesn't work if they're going up or going down, or if they're fluctuating at all, and they fluctuate all the time. So it's pretty straightforward.
I like to. I've answered this way in chapter after chapter that I visited when they asked me about relative value. I'd like to say it's a great measurement for a company that has their high PEs clustered around an average that's 1 or 2 points either side of their average, and the same thing at the low end. But the minute you get numbers that have a lot of deviation from what the 5-year average actually is, you have the opportunity to make a lot of mistakes with relative value, and especially when those numbers start to trend in one direction or another.
And I've told the audiences this before. I think I actually came up with some of the numbers as a teacher in Chicago. I was a volunteer in the Chicago chapter with the. I don't even remember what the numbers were now. 70%. If it was lower than 70%, it was
70 to 110. I can remember teaching it the first 2 years I taught, Mark.
I think I came up with those numbers, and I know where they came from. So just caveat emptor. Let's go ahead and move on. Unless you've got anything else you want to add to that, Ken.
Nope. Let's keep moving here.
Let's talk about it's Christmas, and it's time for giving and gifts and all that kind of stuff. This is a question for Bill Thompson tonight, and that's Bill in the Hat. And what it has to do with is, talking about a company, an old, reliable, almost beloved company that you're thinking about adopting as a child in your portfolio that has suddenly perhaps gotten overvalued. The price is really taking a pretty good run for it. Still got good quality, could be excellent quality, but it's been a really strong contributor. How do you think about selling it in the effect of capital gains taxes? And then he goes on to point out, what type of things, should a person that's perhaps getting on in years, perhaps more along the preservation of capital mode, what type of things should we think about differently? So he says, happy holidays, and thanks for the question, Bill. Your thoughts on this one, Ken?
Well, I think that there's one time of the year when I will entertain a discussion about whether we should take capital gains or not because of the taxes that might be thrown off. And that usually happens in a discussion in the last 2 or 3 weeks of December. I know that my investing club, the big model club that meets in Bridgeport, Michigan, will be looking at its capital gains structure and everything. And sometimes at the December meeting, we'll make a decision if we have a loser to sell a loser, and if we like the stock, we'll have every intention of coming back into that stock, 35, 40, 50 days afterwards if we still think it's a good idea. And we've been known to postpone taking a large capital gain when members have complained that they've done most of their tax planning for the year and they can't afford to throw another $10,000 or $20,000 into their capital gain column. Well, they can afford it, but they don't wish to. Now that's a discussion that revolves around a sizable portfolio. For so many clubs that I visit where you have portfolios at 50,000 or 30,000 or 100,000 or 200,000, and it's divided up among 10, 12, 15 members, I don't really think that capital gains enter the picture all that much unless one of the members owns 95% of the portfolio. I've seen that occasionally in a club with one charter member and then a large component of new members that have been added very recently, within the last couple of years to the club, where one member owns an inordinate amount of the club and therefore has to pay an inordinate amount of any capital gain that's going to be harvested. But for the most part, capital gains are part of the game. It's part of what you pay to play, and I just am thankful to be able to continue to pay capital gains because, frankly, that means that I'm making money on a fairly regular basis. I don't have too many issues with those capital gains. And like I said, the only time of the year when that discussion might be something that my wife and I would enter into would be the last 3-4 weeks in December when we've already done a lot of our tax planning for the tax year. Where do you go with this idea, Mark?
As Ken's already suggested, it really is a personal situation, and I do think you can make a distinction between the the theoretical time horizon of an investment club is, that allows for plenty of assertive investing, versus an individual portfolio for somebody who is getting up there in the years or whatever, or wants to protect a certain balance. The one thing that I would take a little bit of caution, or express a little bit of caution, is I'm not sure it's ever a good time to sell a very high quality company, especially if it's not if it's a borderline or a marginal call, and replace it with a low quality stock, especially in a market like today. I mean, I have done this. Replaced Intel with a Canadian battery technology company. That's not a good idea, and that's a very specific warning that Nicholson gave us. So again, time horizon, very specific stuff. And then the other aspect is, especially when we're talking about individual portfolios, can be very specific. For a person that really is into the capital preservation mode, I think a mom, my mother. More quality, more dividends, a little bit less growth. She's not aiming for 11 anymore. She's aiming for like 8%. So you can dial down the aggressiveness of a portfolio intentionally, especially for an individual portfolio. And in some, I suppose it could apply to clubs. The other thing that I really do like to point out to people, because I've been through this discussion a number of times with people, it gets confusing, it gets emotional when it comes to taxes. Here's the case of Stryker, very popular stock for us about 12 years ago, bought in the high 30s. It's now up in the 150s. It's actually appreciated about 12% a year over the last 12 years. The thing that you do want to do is to avoid the emotion and stick to the facts. Don't confuse the proceeds of sale, that $152, with what the real tax burden is. Even on this stock, which is fairly dramatically appreciated, we're still only talking $17 a share in taxes. And again, in this case, the par on the stock is in the low single digits, 4 to 5%, but that's still not the end of the world. Ken and I were talking about, what are the alternatives? What do you sell that 4% return stock, which is a very high quality company? And what type of bond fund do you go get that really is a superior situation as a place to hide in the cash equivalent? And I just think that hanging on to the blue chip stocks, we're going to talk about this a little bit more with the investment club in a minute, can make a whole lot of sense until they get down below money market rates.
Yeah, Mark, one of the things that attracted me to Manifest originally was a complete shift in asking me to think about the kind of stocks I held, and to think about them in terms of core holdings and non-core holdings. That goes back to original Nicholson, but to also think about the idea that you held a core until it approached what you could get from cash. And with the last 7, 8, 9 years being able to get virtually nothing from cash tells me that I'm going to be very, very loath to get rid of a high quality stock, even if its par value has moved down to 3 or 4%. I'm going to let it drift, and so far I haven't had to sell any that have drifted down to 0 total expected return going forward. But Manifest, I think, has improved my performance in the way I invest by maybe 1.5% or even 2%. And a lot of that is the discipline to hold on to a lower performing stock if it's still giving me better than cash, because frankly, right now, finding alternatives for my money, especially safe alternatives or safer alternatives for my money, is a very difficult game to play. I agree with Mark. I can't find too many bond funds out there that don't have about as much risk as some of my really high quality blue chips that I hold have. And why should I move to something with about the same amount of risk if I have the potential on the other side for a little bit of upside gain that I wouldn't get from a bond fund or from a bond itself?
Mm-hmm. There's a lot of fundamental improvements in these companies that are still not fully reflected too on a company by company basis. So it's a tough question, but again, I think very personal, and you can dial down or dial up whatever you need to be more consistent with a personal investing challenge. So with that, Ken, I think we probably better head into our last segment here. This is an investment club who sent us some questions. They're actually from Colorado, Loveland, Colorado. They've been around for the better part of 26, 27 years. That's the Colorado Gold Rush. That's not actually the club members, and I didn't put Santa caps on any of them because I really like that picture. But they give us a little bit of background. They started with $5,000 each and $40 a month, and a few years ago they decided to stop the $40 per month investment, which is kind of unusual for a club. But again, each club is to itself. Again, just a little bit more information. They do like Value Line for information. They get some ideas from Bivio. We love this club because they say nice things about us. They came to understand the vocabulary over the last several years, and we've been communicating with them now for a few months. And I really like the quote down below. In fact, it'll probably become a part of our testimonial stream that Manifest Investing is an entire investing system. And we feel that way. We really do think it takes some of the emotion out of things. Your portfolio will tell you what it needs. We're going to go into the club portfolio here in a minute. And again, just like Ken was talking about, making decisions on some of the companies that we study, the return forecast and the quality rating are the two most important characteristics, and they will tell you, your portfolio will literally tell you what to do and what it needs. And they recognize the fact that they're in this for the long haul and they are not day traders. So let's go ahead and get started. Again, first and foremost, thank you, investigators. We really do think that we offer a steady stream of opportunities and ideas, actionable ideas. And again, to everybody out there in the audience, I do think that the small company list, the performance speaks for itself. That cover story summary of how these things have done over the last several years. And when I watch my friends and colleagues invest in companies like Neogen 10, 15 years ago, and a whole host of other companies, BioReference Labs, we could do a roll call. These can be very life affecting in a very favorable way. So it is about the idea of demonstrating and sharing actionable ideas. And the one thing this club does that's pretty unique is this notion of not making monthly contributions. It'll be interesting to see as we learn more about them if they're continuing to do that. But here's their first question. What should a meeting look like? I mean, again, this is coming from a fairly experienced investment club. Do we have to sell and buy at each meeting? Should we center our decisions only on the stocks that are in the sweet spot? Ken, what do you think the structure of a good meeting is?
I belong to 4 different investment clubs, and they all have a different flavor.
Used to be,
but they all tend to center around the same fundamentals. These portfolio averages appear quite early in our meetings, whether it's one of the first items of business in one of the clubs or down the agenda just a little bit after you take care of, treasurers and secretaries, stuff like that. But this scoreboard, this portfolio averages compilation appears quite early because it gives people a chance to think about what we need in our portfolio. We know that we're trying to aim at the sweet spot, and the only other piece that we would project at the same time as this is the MyPar number. That's telling us what the average stock is expected to have for a potential return in the next 5 years. And we've already mentioned this evening that's around 6.2%. So when I look at the par number for this club at 8.4, we have to ask ourselves as a club whether that's enough return for where we are in our particular evolution. If we're a club made up of all retirees in their 70s, that might be enough return. That's signifying kind of a safer portfolio. But if we're trying to stick with the goals set by the Modern Investment Club movement, which is to beat the market by 5 points, then 5 points above 6.2 would be 11.2, and the clubs that I belong to are still pretty aggressive, and we're looking to try to hit that par number of around 11% today. Now that number changes. 6 months from now, my par might be 8%. And in that case, we'd try to be aiming at 13% rather than 11. We're trying to beat the market by 5 points. We're always focused on quality, and we're looking to keep our quality in the upper quintile at the 80th percentile or above. That's a weighted average of the stocks that we own. And this club's quality is super. I very rarely visit a better investing club where the quality of the stocks they own isn't superb. We do a really good job of teaching people how to buy high quality stocks. We're not as good in portfolio management, and our selling disciplines sometimes need a lot of work, but as far as buying high quality stocks, we understand that pretty well. Mr. Nicholson told us that in order to reach these goals that we set for ourselves, you need to have enough sales growth. Everything flows from sales. So the sales growth in a typical club that would like to beat the market by 5 points needs to be up around 10.5, 11, 11.5, even 12%. And the sales growth right here is a little bit anemic, but you'll notice that the sales growth tends to match the par number pretty closely. I would guess if I were looking at a pie chart for this, and it's just a guess until we actually look at the chart, but I would guess that this portfolio has a lot more large companies in it than is the recommendation coming from Better Investing. Large companies tend to grow more slowly, 7% or less. And if you have, a lot of them in your portfolio, then you're going to limit your growth in the whole portfolio. I don't worry too much about PE ratio or yield, but I do like to see financial strength and earnings stability, again, up around 75, 80% or better, because I don't want to load my portfolio with companies that are having balance sheets that are questionable, and I don't want to load my companies or my portfolio with companies whose earnings line, that's the blue line in the SSG, looks like a roller coaster. Now, there's room for one or two companies like that in any portfolio, but the aggregate, the portfolio number, the weighted average for the portfolio, I think should be at 75, 80 or better if you're going to put together a great portfolio. So this report card comes up first or sometime early in the meeting to give members the chance to do some thinking about what like to do. If this came up at one of our meetings, I'd be saying to myself, one of the things I want to do if we have money to invest is to try to raise the par value and try to raise the sales growth number. I'd be looking for a faster growing company as far as sales is concerned, and I'd be looking for that faster growing company to have a higher par than the average is right now. I'd also look in, and she says, should our stock decisions center only on those stocks that are clearly in the sweet spot? And no, absolutely not. You need to also center on those stocks where the holding is too small, and you probably want to center on the stock or maybe the bottom two stocks in a really long list because you want to look at what their par values are. You want to ask yourself, are they core holdings or not? Because that might be the most efficient way to raise the par of the portfolio, and that's to put a couple of your lowest potentials on the hot seat and perhaps decide that you want to sell them in favor of something with a higher par. Again, however, and we've said it a half dozen times in this webinar, please don't trade a high-quality stock for something of lower quality. Now, I don't mean 1 or 2 points. That's just trivial. But don't trade a quality stock with an 85 quality for a stock with a 45 quality. That's only asking for trouble in the long run.
So let's go ahead and talk about the actual thing. Oh, I put in a quick plug for Manifest. People have been asking me why Turnout and, what is Manifest about. So here, just a real quick thing. Again, I really like those words, the synonyms for manifest, including demonstration, evidence, obvious, making things plain and revealed. And by the way, Turnout is a synonym for manifest. And had a little fun with Thesaurus Plus. So anyhow, let's talk about doing what Ken was just talking about. And here is the portfolio for investigators. It might be a couple months old, but it works for what we're doing for now. And again, the answer to the question, should we focus on just the companies in the sweet spot? Well, perhaps if we're talking about purchasing, but we often will start our meetings with this sort. It's actually sorted from highest return forecast to the lowest. And the ones down at the bottom are the companies or the stocks that we refer to as being in the hot seat, or the challenge stocks. And in this case, we would probably want to audit and do a deeper dive on Boeing to see if we really believe the growth rates and the types of assumptions you see here, because Boeing does represent 8.4% of the portfolio. That's 8.4% of total assets that you see right here. And if that is the case, and if you believe that this could be a sell candidate after having the debate, the audit, the discussion, it's an opportunity to take $13,777 and deploy it either somewhere else up at the top of this page, those companies up in the sweet spot. That's what she referred to here, these color coded in green. Some of those could be worthy of accumulation, but the opportunity is to possibly do that. Other things that are circled on here, again, the hot seat is earned by this low return forecast, but there are a few other things which kind of reach out and grab us. They do have a fair amount of cash, $21,582 in cash, 13% of assets. So again, you're talking about being able to affect this portfolio fairly dramatically. And then we also see two positions, Cisco and BT Group, that have a relatively small position and relatively weak growth rates. So these could be companies that could be challenged and openly debated within the club. Up at the top, we circled the word partners. That's just simply a reality that holding a stake in a partnership, inside a partnership, causes challenges for club treasurers. We do not like club treasurers to lose sleep or suffer the threat of resignation, because it can do bad things to our investment clubs. So we generally discourage embedding a partnership in a partnership because of the accounting challenges that are produced by that. So that's just something to think about. Bivio has a number of presentations on why that can be an issue and complicates your tax filings. Anything else on this page, Ken, that reaches out and grabs you?
Well, yeah, what I find myself continually doing in the clubs I belong to is reminding the newcomers to the clubs, especially the two model clubs, reminding them that Boeing situation is the result of Boeing doing exceptionally well in the last 8 or 10 or 12 or 14 months. That the reason that you move to the bottom of the par list when you're a good, strong company without anything really going wrong is that your stock is doing extremely well. And you've kind of moved up some of the return and you've taken it off the table in the current stock price, and that lessens the potential for future return. So it's not a bad problem to have with Boeing. You just need to decide whether or not that $13,777 couldn't be put to a little bit better use. Boeing is a very high quality stock. You might want to say to yourself, it's a core holding, and I'm not going to even think about doing anything with it until that par moves down to the 0.7 that cash is earning right now, and I would be perfectly happy with that rationale. The one right above it, however, Cisco, that's an awful small piece of your portfolio, and I would ask myself, do you really want to spend the time covering Cisco and BT Global or BT Group when you have only a limited amount of time to do the kind of work that has to be done for a club? These small holdings eat up time, and time is probably the most precious commodity that any club has in particular. I'm just asking, and I'm looking at the growth numbers for both of those small holdings, the sales growth numbers. I'm saying to myself, you really need more sales growth, and selling a 3.4 seller and a 3.2 seller might start to improve that number, especially if the cash that's generated, along with the cash you hold, gets invested into some quicker growing companies. Again, don't settle for lower quality, but you can find some fairly decent growers that are going to give you some pars. Start for ideas from that best small companies list that we talked about at the top of the webinar. Maybe come up with a few ideas. You don't need more than 3 or 4 ideas, and then take a month or two to test them against some peers and to find out all you can find out about them. And then, I'm not sure why you're holding so much cash. That's an awful lot of cash to hold, and unless there's a reason, and sometimes clubs have a reason, they're building cash to pay out a member or something like that. There could be a very simple explanation, but if the cash is just sitting there because you haven't found somewhere to spend it, I would suggest you work real hard to look for some places to spend it. I want to reiterate Mark's idea about the partnership. It can be a disaster in a club as far as accounting is concerned. It might be a great holding for your personal account, but it's not a good holding for a club account, especially when your treasurer has to dance circles around it when the paperwork comes in. I know that a lot of folks think those are dividends that the partnership is giving you. They aren't. Believe me, they aren't.
Yeah, it's more complicated than that. So anyhow, the best practice to take away is, again, the portfolio will tell you what it needs, and this notion of challenging kind of as a standing practice, I think, is a great idea to audit and debate that bottom one. Okay, let's look at their 2 questions. These are 2 diversification-related questions. Ken, do we need to worry about balancing the portfolio each month by market sectors? And I'll just flatly answer that no. No.
Absolutely not. No. In fact, if you look for good companies, this graph will take care of itself.
Yep, we know that. And then we make the point that in the investor's manual that was put out by the organization, largely compiled by George Nicholson himself, how many times is sector diversification mentioned in the book? Not once. Not once. And in fact, entire chapters are dedicated to smaller companies, faster growing companies. That should tell you something. Are they too heavy in technology? What do you think, Ken?
Well, if that technology, that's the light blue piece,
Yeah.
If that were 75 or 80% of the whole circle, then my answer would be yes. But I don't see any of your sectors overtaking and eating up the rest of the holdings. In fact, I don't usually see this many sectors represented in a better investing club. I think you can have great diversity with only 4 or 5 sectors being represented. You don't need to have a stock in every single sector to have adequate diversity. You just don't.
Yeah, and I would encourage. Again, it really depends on who you are and how you operate. We've worked with clubs in the Puget Sound area that have 40, 50, 60% in technology and are perfectly okay with it. And I've given you the link to an article. That's actually an article by about David Gardner and his Rule Breakers portfolio, where he has had consistently 50 to 60% in technology for a couple of decades now, and he's got extremely solid results. And he talks about companies like Amazon. One of the things he points out is, take Amazon. What is it? Is it a retailer? Is it a logistics company? Is it, it's just not a classical technology company. It depends on technology, but sometimes there's crossovers too.
And Mark, I'm so glad you brought up that crossover idea, because that pie chart can change dramatically depending on whose classification system you're using.
Absolutely.
This pie chart is based on Manifest classification system. If you're looking at your portfolio and you're using Morningstar classification, the pie chart probably looks different. And the same thing's true if you're using Value Line classification system. The pie chart will change because companies move around from sector to sector. Where do you put Apple Computer? You think about it and then look at where the various systems place Apple Computer.
Another reason to be agnostic. All right, a couple quick ones here, I think. Number 3, should we be looking at the futures market, and should we be buying and selling based on the futures market? Again, this one is just kind of a flat no for me. I don't know of any club, I've worked with thousands of clubs, that has ever done this. and again, it just kind of feels like it could be a market timing concept, and that alone would be inconsistent. You can I would point out that a good source for studying about things like this, possibly for an educational segment of an investment club meeting, is like Investopedia.com. That's where that quote was taken from. And again, I don't make the connection. Ken, any connection between the futures market as far as you're concerned?
As far as I'm concerned, no, Mark. Mark, I want to handle just a few questions here before we get much further, because they're kind of germane right now. Okay, so let's see. First of all, Don wants to know, are these slides going to be available? This presentation is going to be posted on YouTube under the Manifest Investing Roundtable channel. That's Manifest Investing Roundtable channel on YouTube. The presentation will be posted there, and I'm sure that if you were to email Mark, he might send those slides out to you as well.
And they'll be posted on the forum also.
Bonnie makes the point that capital gains can also affect Medicare Part B and Part D premiums. And Bonnie, you're absolutely right. Again, whether you sell and take capital gains has to be an extremely personal decision, taking into account everything that make up your financial situation. Lynn wants to know, would you ever sell a Pepsi or a McDonald's just because it has a low par and it's not in the sweet spot? Lynn, I might. But I'm not looking for Pepsi or McDonald's to be in the sweet spot before I sell it. I'm looking for it to get around cash returns, down around 0% before I would consider selling those two core holdings. Now, there are exceptions to every rule, and there might be great times when you think that you have a better replacement for a Pepsi or a McDonald's. But again, I would urge you to resist selling a high-quality stock and then replacing it with a lower-quality stock. That's a trap. Bonnie says, Intel Striker, you are certainly speaking of my struggle. Thank you. Ralph says, would you focus more on reducing the cash in this portfolio before you start doing some selling? Mark, why don't you take that one? What do you think?
Yeah, we're going to go to that next. That's a good segue question. This point number 4, before we move on, market orders versus limit orders. I do 99% of my stuff with market orders. I don't know about you guys. Limit orders are really only necessary for very low liquidity stocks, and something that we could talk about in much greater detail. We've explored it a little bit. Conservative options for stuff. In fact, we may actually talk about selling strategies based around some of these. But again,
I'll tell you what I hate, Mark, is I hate to see a club use limit orders and place them like 10 cents or a quarter or 30 cents below where the market is, hoping to gather a few more dollars in. To me, that's just greedy, and too often that little tiny distance below never gets hit because the stock's moving in the other direction, and that's up.
Yeah, and that's why I gave my Scientific Atlanta situation there. I mean, he just missed getting it down to 50, and then it proceeded to go up 800%. So it's something he never forgets about, again, those type of limit orders. But again, there is a place for them. It falls under the educational umbrella. We have talked about Apple and trailing stop limit orders. That's the sort of thing that you can explore and learn and deploy if it makes sense and is pertinent to your personal situation. So let's go ahead and finish off the last couple of questions. What percentage of cash should be in any portfolio? And we're speaking specifically to this type of investment portfolio at any one time. I think for the vast majority, and Ken already covered it, unless you have a need for paying a withdrawing member or some other need, a partial withdrawal or whatever, I put this picture there for a reason. This is our demonstration portfolio. You can watch every single decision that we make on this thing. It is 100% invested at all times. 100% invested at all times. So during that entire time frame over the last 20 years, you can see how that has performed versus the total stock market known as the Wilshire 5000. The point I like to point out is, where's the end of the world? Where's the end of the world on that chart? We had one of the worst market incidents, catastrophes in the history of investing in 2008 and 2009. and it was nasty. It was absolutely nasty. And yeah, the tin cup model portfolio took a hit, but look how quickly it recovered. And it's this whole notion, this whole discipline of investing in high quality companies at the right price, but it's the high quality that basically keeps you safe during an incident like that. Much of the financial services industry is out there trying to protect us from this. And I don't understand what they're trying to protect us from. The result of what they do is achieve something that's less volatile / less risky. Go back and listen to Sai's presentation on what is real risk, but they end up beneath the red line because they're protecting us. It's just bizarre to me. So again, try to find a good company at a good price and invest in it, especially in an investment club environment. Anything to add to that, Ken?
Nope, you said it great, Mark.
All right, let's go ahead and finish off because this actually comes to Ralph's question. What would you do with this portfolio? Because it is actually 5 percentage points less than the market average, which today is about 6%. And the answer is, yeah, you need to deploy the cash. You need to take a look at some of those holdings in the sweet spot that are more likely to be in the buy zone, high quality, attractive companies. I don't think I would add to Edwards Life Sciences. I suspect that's doing quite well for the club. But at 13.7% of total assets, you probably want to stay away from that one with any new funds. And again, as Ken has already mentioned, maybe you avoid BT Group unless you really have a strong urge to accumulate. But again, that growth rate is going to drag the portfolio average down. So go shopping for the right stocks. And again, kind of closing things out, you can shop inside the sweet spot within the portfolio for stocks likely to be in the buy zone, but you can also go outside the portfolio and simply go out there and look for stocks that if they are brought to the portfolio to deploy some of the cash on hand, they're not going to mess it up. And you can see the search criteria. We're basically looking for a projected annual return or par between an 11.5 and 21.5, not getting too greedy over here. Excellent quality, that upper quintile that Ken was talking about. Again, financial strength, that's kind of like an A plus or above, or an A or above in value line. And again, double-digit growth. So this is a fairly short shopping list where you can go looking for 2 or 3 candidates to study. And there's several community favorites, household names on the list, but there are some that are a little more obscure. But some pretty decent studies on that very quick shopping list going outside the portfolio for some of it. Cognizant's in the portfolio, but some pretty good companies there to study, and you can always come back and ratchet and look at other lists. But this is where I would go if I were a member of this club, or if they handed that money, the portfolio to me and said, what would you do to it? I would shop in this area. The one thing that I do find interesting, Ken and I were talking before we came on a little bit, is the number of consulting and information services companies that are appearing here. That's not necessarily the greatest sign. Many of these are head-to-head competitors, and they're not all going to win. So that can be when too many of them start bubbling to the top of the lists, that can be a warning. Again, caveat emptor, all by itself.
What I also like, Mark, and I've been telling people this, and I wish that you at least would take the time to look at it. A lot of folks are fixated on some of these nosebleed high PE tech companies, and yet I keep seeing on my search results Google showing up with what I consider to be a fairly reasonable PE and a fairly reasonable par value attached to that PE. So I think you can buy high tech, you can buy high growth high tech, and it's available out there for PE values, not price to cash flow values like we were talking about with Amazon, but old-fashioned PE values that are not unreasonable when you consider the growth in the company.
Absolutely. So I think with that, I think we should probably shut down. We appreciate everybody coming tonight. Hopefully we tackled a few questions that you want to see tackled, probably chewed off a little bit more than we should have. We do have a roundtable coming up in 2 weeks. That's Tuesday, December 19th. Same time, same bat channel, where we'll be doing our final roundtable of the year. Probably some eggnog and celebrating, don't you think, Ken?
Oh, we'll have to have something going on. Yeah. I'm sure you'll have some slides with with some fancy hats of some sort, at least, right?
I could work on stock market mistletoe or something, maybe.
I don't know if I want mistletoe, Mark, but we'll
Okay.
see. Tell me, I'm trying to go through our questions here to make sure that we've covered a few of them. Let me see where I'm down here. We've covered a lot of these things. Milo, your question about can bonds protect you in a down market? Mark and I both are of the opinion that you can probably protect yourself in the down market, and that that graph that shows the tin cup portfolio shows how high quality stocks can keep you fairly safe in a market that's doing crazy things. We're just getting some thank yous, and Don
just to
Don wants to know.
Ken, just to reinforce what Milo was asking about there, we actually have done some work with balance type investing, where we took a look at basically switching out of stocks into cash equivalents, just like Nicholson talked about. But again, if you think back to when the market was dropping 40 or 50% back in that, when the world was ending, back in that 2008, 2009 timeframe, you could find a bond fund that maybe went down like 5 or 10%, but our collection, the most common thing we saw, a collection of very excellent, high-quality companies, only went down like 15 or 20%. Not a whole lot more, and it recovered a heck of a lot faster than any bond fund. So I'll try to dig up some of that research and see if we can't share that at a future meeting, at least to show a couple of fun facts and bullet points.
Don is asking us to show how we could actually do an SSG using the cash flow numbers. And Don, we'll put that on something that we'll maybe try to do at the roundtable or in one of these sessions as a demonstration. But I don't want to do it in real time, and we can probably put some slides together and show it pretty easily for you. Mark takes pretty good notes and keeps me honest on what I promise. So we'll try to do that for you in one of the future sessions here. Other than that, we are caught up on our questions. So we want to wish everybody a Merry Christmas. We'll be back with the roundtable before. Are we the Tuesday before Christmas or the Tuesday after Christmas?
So we should be wishing people Merry Christmas shopping, not quite Merry Christmas yet, because we'll get one more opportunity.
Okay, so we're the Tuesday before Christmas. Christmas is on a Monday, so we're in the week before Christmas on a Tuesday, and that's the round table. So we'll see you all then. Happy holidays, great shopping, and that's all we have for tonight. Bye-bye, everybody.
Thanks, Ken.
Thank you, Mark.